All right, there were three of us. Now there are four of us in the studios. Good morning. I mean, welcome back. Anuj is here as well. Anuj, what's happening?
Yes, good to be back in this studio.
I thought you were going to ask him market का हाल क्या है.
वो तो पूछ लेंगे.
You promised us that you were going to start talking in Hindi, Prashant.
वो भी कर लेंगे. लेकिन but Nigel, good to see you here, and of course Sonia as always. Prashant. Let's talk about the market. We have the pre-open rates. There's just 3 or 4 points I'll put across, and then I'll make my way back to the our studio. So the point is that there's been 2 days of bunched up cues that we have to react to, and mostly they're positive. And in any case, we have been outperforming. So for the Indian market, even on bad days, we have been doing well. That I think is something which will keep us in good stead. The texture now is firmly buy on dips. So I'll say one thing. On Tuesday, I made this point that even a gap up could be bought into. Today, the gap up will not give you a good risk reward to buy into. Today, you'll have to really wait for a dip. On Tuesday, even after a gap up, you got 150 points on the Nifty. I think today, if you buy into a gap up, you run into a bit of a risk because if you look at the data, while there's been buying by both FIs and DIs, there's been a massive amount of short covering which already happened on Tuesday. In fact, 36,000 shorts were covered by FIs, 36,000 in a single day. And now the net short position is down to 92,000. 92,000 is still also a lot of short positions, but a bulk of short covering maybe happened on Tuesday itself. The Nifty's base has moved up to 17,200. But the reason I say that, you perhaps do not want to jump straight away is that the Nifty will open right at the 20-day moving average. The 20-day simple moving average is 17,490. This was support on the way down, so on the way up, this could be a bit of a resistance. I think the Bank Nifty could be the index to focus on. That's clearly the leader. The base has now moved up to 38,500. The 20-day moving average on the Bank Nifty is still some distance away at 39,840. So maybe that could be the index to focus on. Also remember, it's weekly options expiry today, so there could be some volatility.
All right, very useful as always, Anuj. Thanks. By the way, Anuj is very eager to run across back to the Avaz studio. Let's keep him here. Let's chat about.
He doesn't have to walk too far anyway.
Thanks
just next door.
Thanks very much, Anuj.
Thanks,
thank you for that. Well, that's the setup with Anuj. Let's bring in Chandan Taparia as well, who's now joining in. By the way, the pre-open rates are ticking. And this is what I saw 25 points, it was 100, and then I think it'll settle down. Give it 2, 3, 4 minutes more, and we'll have better rates. So 17,305 is where the Nifty is kind of opening at. Chandan Taparia, derivative and technical analyst at Motilal Oswal Financial Services, is with us. Chandan, good to have you here. Good morning. How are you treating, market levels here in terms of how the opening is going to be? Maybe a 40, 50 points higher start, and then we take it from there. What would you want to do?
Good morning, Prashant. Thanks for having me. So first, if I talk about the data setup, your CBOE VIX has fallen from 35 to 30 levels in last few days. And at the same time, your Dow has bottomed out with some short covering. India VIX has corrected from 22.9 to 19.5. However, only concern is the FI's long short ratio is not much improving, but market started to form higher lows with crossover and turn of the most of the mechanical indicator from their oversold territory. And if I talk about the seasonality, October has historically positive and better month. So if I sum up the data setup, I believe some positive stance led by festivity could be there in the Indian market. So after the positive opening, if market witnesses any decline, that could be bought. Major support for the index is now going to be at 17,071 and expecting this momentum to extend to us 17,442, and above that the next leg will be to us 17,777. Similarly, in the Bank Nifty, buy on decline will be the stance with major support of 38,888 and expecting this momentum to extend to us call writing juncture of 40,000. So clearly focusing on 17,442 and then positionally 17,777 and looking for 40,000 in the Bank Nifty. Now talking about stocks, positive on the selective consumption name, hotels, banks, and some short covering trigger in IT name. So recommending to buy on Indian Hotel, which has seen good rollover of around 94% in the last series. High tops, higher bottom, fresh breakout, trading at the lifetime high territory. So recommending to buy with a stop loss of 335 and expecting this momentum to extend to us 360 to 365 level. Second trading idea, that is buy on IndusInd Bank. This stock is performing well, 90% rollover, moving upwards from last 4 series. Longs are being added. So momentum could extend to us 1280. One can buy with a stop loss of 1190. Last trading ideas, that is buy on LTI. It seems that Nifty IT has bottomed out. Some more short covering could be seen in the counter. So LTI, TCS, LTTS, Mindtree could be in focus. Here I am recommending to buy on LTI with the view of short covering move. So recommending to buy with stop loss of 4500 and expecting this stock to move by 4 to 5% and rally towards 4800 levels.
Okay, Chandan, have a great day. Thanks a lot for joining in. That's Motilal Oswal Financial Services. Let's take it straight to the pre-opening rates, which are kicking in quite strong actually this morning. Zee Entertainment is up almost 10% in pre-opening on the back of the merger approval coming through. Macrotech developers had a very strong update on their business this time, so looking good. SpiceJet is one of the big movers as the government has increased the credit limit for the aviation sector. And then you have Bajaj Finance, of course, holding strong after a good AUM growth. But I'm also looking at some of the auto stocks. So the Class A truck orders that come through from ACT Research, which is the research organization that puts together this data, has said that it's record high monthly sales for Class A truck orders in North America. And that's a record high of 56,500 units, which is a growth of 102% year on year and 164% month on month. Now, what led to such strong numbers? ACT Research says that OEMs have now fully opened their order books for 2023 a bit earlier than normal. And in their own words, they say that Class A orders were sensational no matter how you slice the data. Over the past 12 months, 249,000 Class 8 orders have been booked, and you'll see the trend on your screen as well. The three stocks in focus: Bharat Forge, Ramkrishna Forging. Okay, that's Jan to April, but this is the more relevant graph. Just look at that surge there. Bharat Forge, Ramkrishna Forging, and GNA Axles looking pretty good.
Okay, all right. Thanks a lot for that, Sonia. Well, let's focus on another company then from the auto space. VS Retailers, they posted very weak set of numbers for September. The total figure, in fact, came in lower by close to 17%. This fall has been led by the tractor segment, which saw a 24% contraction, even at a time when some of the peers, they're sounding very, very positive. Where will we have Mr. Anthony Cherukara, the Chief Executive Officer, who joins us. Hi, Anthony. Morning. Well, things don't appear very bright, actually, for the company. Maybe there were a couple of reasons in the month of September. But by the end of this year, what kind of a number are you looking at, both on the tiller sales as well as on the tractors front? You know, at the halfway mark, you're lagging, particularly on tractor sales. Give us a couple of numbers.
Good morning, Nigel. And as the last 2 months, we have seen a slowdown in retails, especially with the coming in of the festive season in October. We are seeing uptake in retails, so which gives us a positive trend towards closing this year on a positive note, both on the power tiller and the tractor front. On the power tiller front, we are clocking about 17% growth at the moment. We expect to be upwards of 20%. On the tractor side, we are minus 20% now. We expect to be upwards in the single-digit positive growth by the end of the year. However, it depends on the crop prices, which is sustaining at the moment. The reservoirs are full, so the demand drivers are looking good in terms of irrigation and water availability. If the crop prices sustain, I think the retails will pick up as seen in the initial days of the festive season. So we're looking forward to a good second half this year.
But what went wrong in September? I mean, at a time when your peers, like M&M, Escorts, they've been reporting record high numbers. Yours is a steep double-digit fall, and monsoons were above normal, reservoir levels have improved, crop prices have gone up. Why are your numbers not picking up then?
Like I have repeated earlier, we work on a retail model wherein the billing happens based on retails. There has been retail slowdown in the last 2 months. While the rainfall has been good, it has been distributed unevenly across the country, and in some parts of the country, the sowing of paddy got delayed. This is one reason why the retail industry has not really picked up, which is also seen by the retail figures that has been shared by the Dealers Association. We feel that while the festive season is on, the retails will pick up, and the model, which is based on no inventory buildup and a theory of constraint-based supply chain model, will benefit the company in the longer run. So we don't believe in inventory buildup in the dealer channel.
Sonia, actually, that's an important point, because when we spoke with FADA, they said that tractor sales retails are down 1.5%.
Yeah.
So, I mean, Mr. Cherukura's point is well taken. Mr. Cherukura, just stay with us. Just coming back, we have a bunch of other questions, but it's 9:10. Sudarshan is back with us. There's 5 minutes to market open. Sudarshan, what do you have in terms of trades? Good morning.
Good morning. See, you have to buy the Nifty and the Bank Nifty, but do it on a dip. And Adani Ports is a buy with a stop under 804.
Okay. All right. So that's Adani Ports buy at around 804, I think, is the level that Sudarshan outlined. Mr. Cherukura of VSE Tillers, of course, is with us. Mr. Cherukura, just a couple of things. One, you had guided for between 15 and 20% growth in power tillers for the full year. So that you will do that for the full year. And for tractors, you're saying single-digit full-year growth, just to confirm.
Yeah, that is right. We are looking at, currently we are at 17% growth in the power tiller. We expect to be close to 20% by the end of the year. And from the drop that we see in tractors, we expect to be in the single-digit growth with new launches happening in second half.
Right. Okay. Just a quick bit, because at the end of the last quarter, you had talked about launching new products in response to very high competitive intensity. You had said you'd launch in Q2 and next 2 quarters, basically. What's the progress there?
Yeah, the launch is happening. It is happening in Q3 with the festive season. So this month itself, we are launching 2 products in the market with further products to be launched in Q4 as well.
Okay, all right. Anthony, very quickly before we let you go, you had a turnover target of 3,000 crores by 2025. You're going very slow on that front. Do you stick to that?
We stick to that, and the intention of the 3,000 crore is to get the company on an aggressive growth path, which we have done. And we should be able to reach that.
We'll hold you to that number, and we look forward to chatting up with you post your quarterly numbers. We'll talk more about the financial details at that point of time. Thanks so much for joining in. Well, let's focus on a couple of stocks. And Nimesh is standing by in our special segment, to tell us about the Standard Brokerage report that he's picked up. Nimesh.
Hi, Nigel. So today's standard is in Persistent Systems. Interesting upgrade from JP Morgan. They've upgraded the stock to overweight from neutral, and they've also raised the target price to 4,100 now, which means a potential 24% upside from current levels. In fact, Persistent now is the only overweight stock within the ER index space for JP Morgan. Now, four key reasons why they've upgraded the stock. One, they believe the portfolio of Persistent is quite defensive in nature, and hence more resilient compared to the other peers. That's the first one. Second, they have the highest exposure to the US-based companies, and they believe that the tech spends will continue for US-based companies compared to the European clients, and hence there will be a consistent numbers as well for Persistent. That's the second one. Third, Persistent derives the highest share in US in dollar terms, and the dollar has strengthened versus the INR in the last few months. So that's going to be positive as well. And lastly, they expect Persistent to clock earnings highest CAGR of 25% over the next 3 years. So that's the 4 key reasons why they've upgraded the stock. In fact, Persistent is trading at a discount to other peers like LTI and L&T Technologies, and at par with Mindtree, and at close to 26 times 1-year forward earnings. They believe it's an attractive entry point, and hence an upgrade to overweight with a target price of 4,100, a potential 24% upside from current levels.
Okay, very interesting. Revised to overweight from neutral on Persistent. We'll keep an eye out on the other IT stocks as well. But Bajaj Finance, there's a bull and bear case argument here. Abhishek is joining in for more on that. Abhishek.
Well, Sonia, to begin with the bulls, they are happy with the fact that, AUM growth is strong. Liquidity surplus has reduced, which means that earning potential has increased. There is significant growth in deposits, up about 15-16% on a sequential basis. And the company is well positioned for strong growth revival that they are seeing on account of festive season and going ahead. So we have brokerages like Jefferies, Morgan Stanley, and Bank of America, Merrill Lynch, who have a target price ranging from as low as 8,000 per share to as high as 8,500 per share. On the other hand, we also have bears who say that the AUM growth is strong, but loan disbursals is weak. So it's the average ticket size which is helping the loan growth this time around. And there is divergence between volume and value growth. So growth may take a hit when inflation cools down. They believe that most of the growth has come in on account of inflation. And if loans are driven by mortgage, it's a low ROE product of about 11 to 12% ROE. recovery. So brokerages like CLSA and Macquarie have a target price as low as 5,000 rupees per share and 5,600 per share. Back to you.
Okay, thanks a lot for that. Just about 6 seconds left for the market opening. In the broader markets, of course, names like SpiceJet are surging. But here's the first take on the index. It's a strong start to trade. The Nifty is up 113 points right now and counting. The Sensex is up over 450 odd points, led by a lot of the large caps. ICICI Bank, Infosys are topping the charts this morning. In fact, the entire IT pack ahead of the numbers next week. There's Infosys, HCL Tech, all up anywhere between 1 to 1.5%. Hindalco is the other big mover, up 2% right now, followed by ONGC, which is seeing a gain of 1.5%. Autos are also coming back, so Tata Motors is up about 1%. But it's really banks that are leading from the front. Bajaj Finance, on the back of that strong AUM growth, the highest in the last 11 quarters. The twins, actually, Bajaj Finance and Finserv, are looking pretty good. So do keep an eye out on that. What is not in the green? Nothing. Surprise, surprise. All Nifty constituents are in the green right now. But the ones that are perhaps taking a little bit of a backseat is Pharma. So Dr. Reddy's, Cipla in the green, but not as much. Cipla, in fact, mild red tick over there. But largely, you'd have to say Infosys, by the way, is your top Nifty gainer right now, 1.5% higher. And that's leading charge. The market breadth also very, very healthy. Almost 10 is to 1 in favor of the advances.
Well, Sonia, just take a look at the breadth of the market. A couple of stocks doing very, very well. Bharat Forge, that's the one that reacts to the North America truck orders. And that one, in fact, is up close to 7%. JNA Axles as well flying away. And you have Forgings as well. That's up and about in today's trading session. Z Entertainment in pre-market well was indicating a big 10% uptake. That's tapered down a little bit. Remember, it ended higher even in Tuesday's trading session. A few more names. Godrej Consumer, well, the quarterly update wasn't that great, so that's one of the big underperformers. In fact, that's down close to around 3%. Ratnamani Metals, well, they acquired Ravi Technologies. Valuation-wise look pretty good, though it's not a related business, but most brokerages believe that that will be a step in the right direction. So that one is up and about. Nykaa, keep an eye on that stock. They're going to be making some strategic announcement later this evening. So let's get the initial rate out there, more or less flattish to kickstart trade. IEX, the monthly update, well, there was a bit of a growth on a month-on-month basis, though it was a little bit disappointing. However, the stock has been a big underperformer, so some bit of a bounce on that front. Max Ventures seeing some follow-through buying after a good close in Tuesday's trading session as well. So pretty good start to trade. We're starting in that congestion zone on the Nifty. Yeah. Let's see whether or not we can go ahead and take out that high. I think the high for today is 17,425.
I mean, Nigel, the good thing is that it's not a wildly optimistic blowout kind of a start, right? So it leaves room for the market to do more later in the day, I mean, after the initial adjustment, which always does happen. So it's a 100-point plus start, which is, reasonable given the kind of price action we had last 2 days. I mean, you're basically coming up this morning with reacting to a 3% up move on the S&P. Of course, I mean, you've got to adjust for the, already existing outperformance, but day on day, near term, you're kind of responding to strong gains in the US. Z is, of course, the stock of the day as expected. It's up 5%, 280 is where it is. Persistent, I think we highlighted, Nimesh highlighted that as a JP Morgan standout name, 4% higher on that one as well. Jubilant Food is coming up with a 2% pop. It's got decent sized volumes, by the way. Bharat Forge is up 6.25%, which Sonia highlighted. And that's a very aggressive move on Bharat Forge at this point. Poonawalla FinCorp is up 2%, 322. There is Vedanta, which is up 2.6%. Motherson is starting about 3.25%, 3.35% higher. Lots of stuff moving around. PVR is up about 2.5%. There is Lemon Tree, which is up 1.5%. Max Ventures is coming up. This was up 20% on Friday. And the only reason it's coming up on my screen is because of volumes. It doesn't ever show up anywhere near the top traded names, but it was on Friday. And it is coming up with decent sized volumes. Nothing very large, but decent sized volumes. It's up about another 3.5% after the 20% move on Tuesday, not Friday. APL Apollo, SpiceJet is up 7%, as Sonia was pointing out. Devyani, I think there is an initiation report from one of the sell side houses. Devyani is up 2%. All Cargo is up 2%, and so on and so forth. So this is a pretty decent start. 8:1 in favor of advances. Godrej Properties is the only, Godrej Consumer Products, beg your pardon, is the only one which is down meaningfully with a 5% cut. Maybe a Varun Beverages as well, which is down 3%. Sonia.
And we were discussing, right, about how the business updates of all the companies, even this morning, I mean, the strike rate is pretty good. If you look at it, AU Small Finance, Poonawalla FinCorp, Bajaj Finance, Macrotech Developers, all have reported pretty strong business updates. And that's...
Absolutely. I mean, it's looking good, isn't it? And financials especially, I think, is where bulk of that momentum really is coming through from. And that's the space where the market is very focused on as well. Our market master of the day is with us. Gautam Trivedi is co-founder and managing partner at Napier Capital. Gautam, great to have you back on the program. Thank you very much for your time. It's been a while, so would be good to hear your thoughts. And so much has happened, right, Gautam, in the world, and a little bit here as well, in India as well. We've had a rate hike from the Reserve Bank. There's perhaps one more to go, according to a poll that we conducted. So not that much tightening in terms of what the market is expecting. How are you looking at things, and more positive or a little cautious now? What's your sense?
No, I think we should remain cautious, and I don't think the Fed's rate hikes have obviously, I don't think they're going to go slow. The Fed's war on inflation, that's resulting in this interest rates going up globally and the strengthening of the dollar. Unfortunately, emerging markets like us, like India, are basically collateral damage. And that's causing imported inflation. And I kind of feel bad for the RBI because you're stuck between a rock and a hard place. If you raise rates too much, you end up hurting the domestic demand, which has actually revived significantly in the last 2 quarters. At the same time, if you don't, then you're in a situation where your rupee slides further, causing more imported inflation. So I think that is obviously one issue. Second issue that I see going into the fourth quarter of this calendar year is the fact that commodity inflation, I don't think, is going down anytime soon. It's going to remain elevated. And you've seen what's happened even with the case of oil, even though it's corrected 27% since its high of $128, at $94 a barrel, I'm referring to Brent, it's still very expensive for most emerging markets, including India. So, and again, OPEC's decision to cut oil production by 2 million barrels a day isn't going to help the situation. So I think given these factors, we still remain cautious. The good news is India's got a lot going for it, but will it decouple? We don't think so.
Okay, still remain cautious. Gautam, good morning. So what are your thoughts on whether there is more downside in this market left? And if yes, how does one approach it?
I think downside is certainly left in this market. I tell you where I'm coming from. Again, in spite of all the stuff that we've seen, and of course, you've seen some degree of FIs coming back into the market, which was a positive briefly. Again, last month, they sold almost $1 billion. So I think what we've seen in every major correction, and I'm looking at the number of corrections that have happened in Asia, and you've seen since 1990, the S&P 500 index has corrected 10% or more 26 times. And each time it's taken down global markets, including Asia and India with it. So will India end up decoupling? I don't think so. What we see is the other concern, of course, is in terms of valuation. And again, I've said this before, India has, of course, always been one of the most expensive markets among the emerging markets and always the most expensive Asian market. But now we're at 20.3 times calendar 23 PE, which is more than double that of China's. MSCI China is now at 9.3 times. MSCI emerging markets are even at 11.2 times. So given that, I think, given all of that, I think the market is essentially too highly priced, and a correction actually would be a great positive.
Hi, Gautam. If we are to see a correction, how deep do you think we could go from here? Do you think that June lows of around 15,200 odd, we could revisit that, maybe go below that?
We could certainly revisit that. I don't know about going below that, but certainly revisit that. And the reason I say that is because we've tested that once already. Now, let's keep a couple of other factors in mind. That, yes, the recession and the issues that are there in the West are not necessarily the same issues that we have back home in India. So let's get practical about that. Having said that, so for example, we don't have electricity issues like Europe has. We don't have labor shortage issues like the United States has. Of course, we have a lot of labor here. But having said that, I think it's going to be the correction in the markets And to the level to which the Nifty drops is going to be a function of how much more money retail investors keep putting into the market. Now, don't forget, until maybe about even 6 months ago, the only real alternative in the equity markets was basically equities. Investment opportunities were equities. And now we've seen rates going up significantly. We've seen a revival in the real estate market, which is ironically funded out of gains made in the equity markets. So finally, investors in India have two more alternatives versus pure equities. So I think as rates continue to go up, and which I'm sure they will, I think some of the money that would have been destined for the equity markets will start finding other avenues of investments. So the ability to support this market when that fall does come, and I hope it doesn't come, but assuming it does come, will be, I think, driven by how much more attractive other alternative investments are.
Gautam, so you're basically saying that some of the resilience will break at some point, and people will throw in the towel here. Gautam, is that what you're saying? As the US stays focused on raising rates, markets continue to be under pressure there?
I think so to some extent, because the fact is that the US, what's happening in the US is impacting the whole world, and we're not immune to it. And this has nothing to do with the government's policies or any of that, right? This is what the United States is doing, and the US dollar remains the major currency for trade, major currency for conducting business globally. It may change, and as attempts are being made by other currencies to try and get a bite out of that market, but that's a prolonged process. The other thing which I think is going to continue to impact inflation, I think, which people are sort of undermining to some extent, is the fact that global corporations, I think it's dawned upon them that there is no quick fix to the supply chain bottlenecks. The China plus one strategy will take time. It's not going to be done in the next 12 to 18 months. It will take, I think at least 4 to 5 years for it to be implemented and mature. And as a result, in the medium term, inflation is here to stay. It's not going away.
Okay. Would you buy IT stocks now, Gautam, ahead of the earnings?
Actually, no. I think anybody who's in the export side of the business, and again, as we know, two of our biggest markets for exports for India, and not just for IT, but even merchandise exports, are the United States, i.e. North America and the European Union. So as a result, both of those which are currently undergoing economic challenges, I think I'd stay away from anybody who's in the export side.
Right, Gautam, the last time we chatted, I think a couple of months or so ago, you're fairly positive on telecom, and I think Bharti Airtel was a stock that you were fairly positive on, and that was an outperformer in an otherwise weak September. You continue to hold that positive stance, and would Bharti Airtel be the only way of playing it?
Well, unfortunately, yes. Bharti is the only real way of playing it. I wish Jio was listed, but that's not going to happen until the company takes a call when to do that. The other alternative is Vodafone, and that's obviously a very high beta bet if somebody does want to take it. And the last alternative, which is MTNL, unfortunately, even the government seems to have thrown in the towel for MTNL. So Bharti remains the only real way to play the telecom and mobile sector, and I would continue to advise investors to hold that.
Where else, single stocks, are you finding opportunities, Gautam, like Bharti? What else?
Well, I think, I think, I don't want to get into single stock specific recommendations, but what I would say is that what's good is very expensive, and what's not good is also expensive. So we're today in a situation where I'm just giving an example of a Pidilite, okay, market leader, 141,000 crores market cap, and a steady compounder. But the problem is the stock's now at 68 times FY24 earnings. Would you have the courage to buy the stock at this price and this valuation? Probably not. So I think there's from a longer term perspective, if a correction does come, would be a perfect time to buy.
Okay, well, it always works like that, right? You have to pay a price for premium products. Wanted to ask you a little bit about autos. There's a big breakaway over there coming out of a long bear market. And we were just narrating how even in markets like North America, truck orders are now at record highs. So a lot of companies benefiting from that. If you had to play this pocket now, where would your preferences lie?
I would still stick to the passenger car segment right now, because the fact is you're seeing a massive flurry of orders and demand coming in literally across the board, and I'm not referring only to Maruti, even the non-Maruti segment, which is the other 50% of India's demand, we are seeing a lot of interest coming in. So I think the passenger car segment clearly is doing fantastic. You've seen the numbers that came out of FADA, which are very positive, comparing them to September of 2019, where passenger car sales are up as much as 44%. And the segment that's not doing well and not done well, which is down 14%, are the two-wheelers. And I was kind of surprised yesterday when I was looking up some of these stocks and to find that the market cap of Hero is half of that of Bajaj Auto. I'm not necessarily saying it's time to buy the stock, but I didn't realize the stock had fallen as much as that. So I think there could be potential opportunities out there from a very longer term perspective. But until rural India doesn't pick up, I think a lot of these stocks.
Oops. Okay, I think, all right, Gautam, we will leave it at that. Thanks a lot for joining in and taking us through your views on the market. That's an optimistic Gautam Trivedi saying that, yes, things are going to, I mean, there could be some caution in the system for a while, but overall, there's some downside left in the market, but in the larger scheme of things, things will definitely improve. But Bank of Baroda is the next corporate that we're speaking to after the Q2 business update. While momentum has sustained on loan growth, deposits have declined for the quarter gone by. Sanjeev Chadda, the MD and CEO at Bank of Baroda, joins us now to talk about that. Mr. Chadda, good morning and thanks a lot for joining in. Can you tell us what the prognosis is for credit growth, given that we have higher inflation, higher interest rates, and that perhaps could dampen demand, especially at the retail end? Your thoughts, sir?
Very good morning. So to my mind, if you look at credit growth and if you look at the medium-term perspective, I think there's a lot of improvement in terms of the sentiment and also the fact that it has become much more broad-based as compared to previous quarters. I think you would see that in terms of credit growth numbers, it's coming from virtually all segments. It's coming from retail loans, from MSMEs, from agriculture, and also now corporates. To that extent, I think the prognosis is very positive. But if you were to look at headline numbers, YOY growth, then I think we do need to keep in mind that like the overall growth rate, these numbers have been flattered by the low base effect. So to that extent, some correction might happen. But if we were to refer back to what our view was at the beginning of the year, that we might have growth which might be maybe double-digit early teens, significantly better than last year, I think that's something that's likely to be borne out.
Okay, so double digits and you're likely to outgrow the market. I think you've maintained that as well in the past, Mr. Chadda. Well, let's focus on your NIMs. In the first quarter, it saw a bit of a downtake in comparison to quarter four, but quarter four had a bit of a bump up. Now the street is working with improvement on the NIMs front from here on. So could you tell us about that? Some are working with around 20 basis points. Would you concur? And also on the credit cost side, the hope is that things will cool off from here. I think you were guiding for around 1.25%, though the first quarter was very much, pleasing to the eye. What's the outlook on both these two parameters?
So let me talk in terms of the broader industry and how it's likely to pan out. So I think in terms of net interest margins, in any environment where interest rates are declining, which it was last year, where liquidity is sloshing around, it's much more difficult to keep margins intact. And I think there was a successful move by banks to make sure that liquidity management came to the forefront. Now that when we are seeing a reversal of that, to my mind, there is enough momentum in this development to make sure that margins are maintained and strengthened as we go along. Along with that, again, referring back to the previous point about credit growth, that would mean that pricing power, which had got eroded because of the fact that terms of trade, very frankly, were not in favor of banks, that is also coming back. So to my mind, margins, again, ought to improve for the industry as a whole. And again, just coming to your second point, if you would just repeat that, please. My apologies.
I think you were guiding for around 1.25%. The first quarter was fairly under control. The hope is that that cools off, maybe to the 1% or sub 1% mark. Outlook on that front?
So I think there is a secular trend in terms of credit costs coming down. that has been in operation for many quarters now, and that stood even the test of COVID. Now that COVID is behind us, and also the corporate credit cycle is pretty much as good as it has been in terms of the risk profile for the past many years. I think recently we had also the statistics from CRISIL that in terms of upgrades, that's something which is far outnumbering downgrades. So I think if we would take all these things in tandem, I think to my mind, there's still some steam left in terms of the improvement of the corporate credit cycle and the overall numbers in terms of credit costs. So therefore, I would concur with the view that overall for the industry, there's still room for some improvement.
You want to give us a number?
I beg your pardon?
You want to give us a number? It can improve to what? To around 1%?
So I would desist again from giving a number for BOB at this particular point in time. But I think the broad-based improvement which has been there is likely to continue for the industry and presumably for the bank also.
Okay, I just had one follow-up on the earlier comment you made about credit growth being in the teens, you said, and the double-digit growth is perhaps what you're looking at. Can you break that up for us in terms of what the retail growth could look like? How is SME loan growth shaping up? And also on the corporate side, because a large banker last week told us that corporate loan growth is coming back in a big way. Would you concur with that? And if you can share any numbers?
So I think if we were to refer back to the results that we had reported last quarter, what you find is that the growth momentum as far as retail is concerned, that is picking up, right? It is still very strong. It was strong through COVID and is picking up. As again, I think Gautam, again, your previous speaker spoke about, again, the automobile industry, car numbers. So I think there's a lot of, also again, in terms of developers, right? So I think there's a lot of secular positive trends which are in place to ensure that retail credit growth continues in terms of momentum. And also, if you see whatever the impact of the recent rate rises has been, I think that's something which has been well absorbed by the market. Along with that, again, if you go to add the relative improvement in corporate credit growth, which again for banks like ours is nearly 45-50% of the balance sheet, it has a disproportionate impact on the overall numbers. So yes, I think I would be quite sanguine in terms of the current growth momentum continuing, particularly because corporate growth is still, to my mind, likely to be significantly lower than overall retail growth, but it's still, as compared to the last few years and also the last year, significantly better.
And it's on an improving trajectory, is it, sir?
Absolutely.
It's picking up pace. All right. That's important. I mean, a top banker always has a bird's eye view on what's happening, and it's good to hear that from you. Mr. Chadha, just a quick word on, this entire fintech ecosystem. So there are 2 points. One, RBI has come down pretty hard, right? There are on the entire digital lending ecosystem. I mean, at least it's tightened the screws, tightened the rules. So it's not a free-for-all. There's talk of a business model, BNPL, etc., no longer viable. Banks were also very aggressively tying up over the last year or so with fintechs, etc. Could you just give us a sense of how this space is likely to evolve? And is there any specific impact because of what has happened to Bank of Baroda's business per se? Go on.
So I think when it comes to the digital piece, the impact is again in terms of organic business, and 2 in terms of what you can do in collaboration with fintechs. So I think both these trends are likely to continue. Talking about BOB again and referring back to our numbers in the last quarter, you would have seen that the unsecured personal loans actually were up nearly 100% YOY. That largely has been because of the success that we have seen with Bob World, which has acquired something like 22 million customers in a single year, giving us operating leverage, which is really unprecedented and which is something which is likely to play out in the future also. Now, in terms of the RBI changes, I think we have to see it in the context that the regulator needs to strike a very fine balance between ensuring that there is innovation, but also when certain players or certain businesses reach critical mass, that there is some regulation. So I would not really see it as a clampdown, but the fact that now the sector is mature enough for the regulator to make sure that there are some rules to guide the growth going forward. I think one of the things which has been very apparent is that the paradigm in terms of the banks working with the fintechs, with NBFCs, has firmly shifted towards collaboration. And I think that is something which is likely to get strengthened even further, so that the respective strengths of the players, banks again in terms of having a low cost liability franchise, being regulated, mature risk management systems, and fintechs in terms of driving innovation, bringing costs down. I think if these two trends were to come together, it should have an overall salutary impact on the entire financial system.
All right, Mr. Chadha, we don't want any near-term guidance. I think you're being a little bit cautious on that front. But in the next couple of years, where do you see the ROEs headed? I ask you this because margins are improving, credit costs are cooling down, and OPEX cost is reasonably under control. The broad estimate is you'll move from the high single-digit ROEs to, say, around 12 to around 14%. Would you concur? Do you want to give us a number? I reiterate, not in the near term, but say in the next couple of fiscals.
So I think the drivers that you have very correctly identified are indeed there and they're operating. And I think out of these, the two powerful drivers are going to be the improvement in terms of credit costs, which is likely to continue through successive quarters. And also the fact that for banks, the model again has changed in terms of growth, not necessarily having a concomitant impact in terms of the cost base. For example, again, if you would look at BOB, the fact is that we have, as of now, fewer branches than we had 2 years back. We may also have fewer people on our permanent roles, but in terms of the growth momentum, it is actually taking off. So therefore, I think this change which has happened from the time when if you needed to grow a business, you needed to grow costs in tandem, to again now when actually costs are not likely to really move in the same proportion, is also going to have a very powerful impact in terms of operating leverage. So I would concur with your views that in terms of return on assets and return on equity, we should be seeing a broad-based and a secular trend towards improvement.
All right, we'll leave it at that. Mr. Chadha, thanks a lot for joining us and speaking to us on CNBC TV 18. That's Bank of Baroda. By the way, the market, although the Nifty is still holding up with about a 100-point gain, there's plenty of traction in the mid-caps. Take a look at that, 320 points higher for the mid-cap index. And lots of stocks, Bharat Forge, SpiceJet, Samvardhan Motherson, Poonawalla FinCorp, DLF, all on the back of business updates, looking pretty good at the moment. Let's do one thing. Let's take a quick commercial break on that note. On the other side of the break, we'll continue cracking with the markets and individual stocks. Do stay tuned in.